Hi, thanks for tuning in. You're watching Ask BQ, where we take all your stock market related questions and ask our guests to answer them for you. I'm Smriti Chaudhary and with me is Alex Matthew. Before we begin, do send us your questions to the YouTube live chat or through the WhatsApp number that's on your screen. You can also send in your questions to any of our social media channels. Now, let me introduce you to our guests for today. We have with us Mr. Kunal Rambhia, founder The Street, and Dharmesh Kant, head equity research at Chola Securities. Welcome and thank you for taking the time out. Now, today we are focusing on the metal index, which is in the green today. Alex, what do you think is the reason for that, and why is the index finally jumping today?
Well, it's been a bit of an underperformance in the recent past, Smriti, and that's primarily because of question marks about China's growth and China's economy. But then if you paid attention to the headlines earlier this morning, then you will have seen that there's what some people are calling a mini stimulus that China's government has announced. The fiscal deficit is going to be allowed to go to 3.8% from 3% currently, and they're going to increase the amount of government borrowing in order to fund that deficit. However, it has been pointed out by experts that we've spoken to through the day today as well, that this is not targeted at the real estate sector, which is the cause for concern right now. And it's not necessarily targeted at consumption yet. So somebody like an Andrew Holland, for example, has said that the Chinese government seems to be using a pea shooter where it needs to actually be using a bazooka. So that is a perspective right now. Whether or not it has a bearing on metals is what I'm going to ask my guests about. But before we do, let's talk about the benchmark Nifty 50 and the equity markets as a whole. Very quickly, gentlemen. Kunal, I'll come to you first. We're down about 0.2% for the benchmark right now. Where is it heading? Will it find support at 19,200, or are we talking about levels that are much below that?
Very good morning to everyone. Morning, Alex. So if you look at the Nifty, so we saw the first breakout precisely on the 30th of June, and that was at around 19,100 to 150 levels. And post that, we saw 19,200 to 50 levels being retested almost 3 to 4 times. Recently, just presently, we are again back to 19,250 levels. Precisely right now, we are at 19,230. So the levels to watch out from here will be 19,150 to 200 kind of zone, which seems to be a good support level because multiple times Nifty took the support there itself. Failing to hold to these levels, I think we are heading for a bigger correction, deeper correction that might just extend up to 18,400 levels. But if we hold on to these levels, then definitely a dead cat bounce till at least 19,500 to 550 can be expected in the time to come.
Dharmesh, coming to you on the metals pack and also your view on whether or not 18,400 for the Nifty 50 is on the cards. And if it does indeed happen, if there is a bit of a slide from this point, would you be buying metals?
Yeah, good morning, Alex. First, I'll take on the Nifty. 18 and a half, 17 and a half to 18 and a half is the comfort zone of 1 year forward earnings multiple of Nifty. And if you look at FY20's 5 earnings expectation, it is around 1,000 to 1,050 kind of a scenario where the Nifty EPS is being expected out there. So to reach to comfort zone, 18,500, 18,400 can be a good comfort zone for the market, where value pick and cherry picking can be done. Coming to the metal part, metal as far as domestic centric metal companies are concerned, primarily the steel producers or iron ore producers, even the base metals like copper, zinc, aluminum. That segment is doing very well. I mean, there is no problem out there. The demand has been extremely strong. At the same time, metal companies are raising up their productions to meet the upcoming demand, which is there in the metal space. The problem is there in the international market. I heard you talking about the Chinese part. See, China has one strategy in place. They do it piecemeal basis. They don't immediately pump all their bullets. They keep it on a piecemeal basis. So once a stimulus chain is being activated, it keeps on coming in bits and pieces over a period of time. So that's a comfort zone from there. But if you look at international metal prices for say last 14 years, 13 years, they are still 15 to 20% above the last 14 years high. Either the high was made in 2006-07 or it was made in 10-11. So they are pretty much below that. And talking about steel, it is still a $71,000 price, which is last 14 years mean level. So prices don't go up. Consumption side, it is 1.5% only. Worldwide consumption is happening, which includes China in place. So internationally, I don't see a traction out there, but domestic market is hot and buzzing. And this ensuing correction, if it happens, if the market does fall to 18,400 kind of a level on Nifty or to 18,000 back, I think there are plenty of good opportunities, metals being one of them. The only choice would be maybe domestic focused metal companies. So, for example, steel companies like JSW Steel or Jindal Steel and Power, Steel Authority of India, NMDC, even Hindalco. These are the companies where one should be looking at to add to their portfolios in the fall if it materializes.
All right. We've got questions now lined up, and I think this is the time for me to remind all of our viewers that are tuned in on our various social media platforms. We are taking questions on any listed companies. Of course, we can take those questions. Whether or not our experts have a view on them is another matter altogether. But I'm sure that if they don't have specific coverage, they'll give you an alternative to talk about. Chandrasekhar has got the first question. He's holding UPL at an average price of 635.4, and he plans to hold or accumulate. What is the target price that you can talk about for the next 6 to 12 months? So first we'll talk about technical because it's a slightly shorter time frame, and then I will come to you, Dharmesh, on the fundamental aspects that could affect UPL. Kunal, first to you.
So, Alex, if you look at the overall formation on the UPL chart, that's from 2021 so far, I think this counter was holding up to 615 levels decisively. In fact, 5 to 6 times it tested that level, but it was a success. Recently, it actually slipped below that level, and now it's holding on to those 580 levels, which we saw just a month back or something. So, immediate support on the chart would be, say, 580. Failing to hold these levels, I think it might just come down to 540 to 525 levels. So I think I'll be cautious at this point in time. I would advise our viewer to keep the stop loss of around 580 on the closing basis. If the counter manages to hold the levels, hold on to your position. Otherwise, I would advise to take an exit and revisit the counter if it reaches near to 540 levels.
Dharmesh, on the fundamentals, what's the view on this particular counter, UPL?
See, Alex, the entire space has been in a problem for last 1 year, and UPL is the largest among the lot as far as market cap and the business is concerned. It caters to all segment of chemical industry, be it agrochemical, specialty chemical, or herbicide, pesticide, insecticide, everything they have under their basket, along with the seed business which they have. I think the recent price correction is more to do with the international prices of the chemicals they produce, particularly the specialty chemicals and the intermediaries of the chemical and the agro side. Some semblance or some comfort was there in the last 1.5 months where the prices got stabilized in the European and the Russian market and Chinese market as well. And some stimulus was coming in from China is again a good for positive factor. So we did see a bounce back in most of the chemical-oriented companies, but this gets sold into because of the recent market correction. So my advice would be for if you are having a 1 year perspective, and as our colleague pointed out, it can go down to 540 or 560 levels. So keep on holding the position which you have taken. At the same time, if it comes down and you are getting a good bargain, please add on to the positions out there. 1 year price target is definitely above 690, 700 plus. So valuation wise, it's trading at all-time low valuation multiples, and the type of growth trajectory I see for this company going forward for next 1 year. So 12 to 15% kind of a CAGR is absolutely there on the revenue side, as well as margins are likely to improve. So that will trigger a buy in this. As of now, because of this turbulent environment, we are seeing a selling pressure, but this is a time to add on to UPL. 1 year time frame price target would be 690 to 700.
All right. Next up, we have a question in the garment space. The stock is Go Fashion and it's in the green today and has given gains of about 24%. The question is from Mehek and she wants to know if it's a good time to add the stock in the portfolio. Kunal, let's go to you first. Go Fashion.
So again, if you look at the overall formation of this chart since inception, that's of 2021, I think this counter has consistently made highs near to 1350 to 1400 kind of levels, and on the lower side, it came down to as low as 925. Right now, it's trading at 1305. Certainly, the trend is definitely positive, but it's reaching near to that resistance mark which we witnessed earlier. So I would say stay cautious on this. buying near to those extreme low levels, so far it has given two opportunities. I think in the time to come, it might just again give you the opportunity to accumulate. Think over buying near 1,000 levels rather than 1,300. And by any chance, if the counter manages to cross 1,400 on the higher side, I would consider that to be the breakout zone. We'll revisit the counter at that point in time. But for now, I think avoid this counter.
We've got a question coming in from Navdeep, and Navdeep is asking about NMDC steel. And we spoke about the wider steel pack. We spoke about metals in general, but this is a counter, gentlemen, that's fallen quite substantially in the recent past. Over the last month, it's down about 20% or thereabouts, but that's after quite a bit of a run up. Is that the reason why it is dropping right now? And what is your specific advice that you would give if you haven't bought? Should you consider looking at this right now? If you're holding, what should the strategy be? Kunal first.
So again, Alex, in technicals, we give a lot of importance to the previous highs and the lows, right? So we saw the breakout on this chart near to 39, 50, 40 levels. And from there, it went up to as high as 60, which was almost 50% rally. And again, it's coming back to the same zone. The chances are that this level might act as a support now. So just watch out for this counter near to 40 levels, which is almost there now. If it consolidates at the present level, then certainly it's the time to accumulate the counter, keep the stop loss of 35 and go long on it. But I would not really be catching the falling knife. I'll wait for the counter to settle down near to 40 and then initiate a buy.
What about on the fundamentals then? NMDC steel specifically, I think you did mention that if there are drops, NMDC can be looked at as an option apart from the other domestic steel manufacturers.
Definitely, yes, Alex. I think it's a buy on every decline. The company has having a very robust fundamentals, and they have a monopoly business as far as iron ore production in India is concerned. So more than 90% of the iron ore is being supplied by them, and they have a bandwidth to increase the production depending upon the demand scenario. Of late, we have seen, I mean, last 3-4 months, if you look at it, the prices of both lump iron ore and fines have gone up by 50 to 10%, and they have enjoyed that benefit. Will come to them when they report their Q2 earnings and Q3 earnings going forward. Demand has been robust out there for iron ore supplies, as we spoke about regarding the steel demand based on infrastructure. What was happening with this company earlier was because of the integrated steel plant coming to as a subsidiary, there was overhang on the stock, and it was always very undervalued. So now I think the valuation catch-up is playing out 23-24%, a kind of an ROE with a revenue and PAT figure of more than 10%. It's still available at 8-9 kind of PE multiple. So a lot of juice still there. I think 130, 140, as our friend pointed out, is a good level to accumulate it and buy again. Upside target can be anywhere between 210 to 240, but this target I am giving based on FY26 earnings multiple. So if you have a vision of a couple of years of holding, so a very nice gain of 60-70% can be made on this stock, but you should be holding it for that time frame.
All right. Next up, we have a question from Netra, and she is asking about Amber Enterprises. Now, the company came out with its results a couple of days ago. While revenue and EBITDA jumped, the loss widened. She is asking about the stock that she bought. She bought 50 shares of Amber Enterprises at 2726 per share. What are the levels expected going on from here? So let's look at the short-term view first. Kunal, what do you think about Amber Enterprises? What are the charts showing?
So honestly speaking, the formations are really strong. And if you look at the recent rally from May low levels, I think from 1700, this counter has come up to as high as 3000 levels. And it's been a month, I think couple of months, it's in the sideways consolidation. And the resistance level is placed at around 3100 and the support being 2800. So I think hold on to this counter as of now. If this counter manages to cross 3100, I think the next immediate resistance level and the potential target would be 3500. So yes, stay bullish on this counter. Put a stop loss of around 2800 on a safer side. Manages to close below 2800, will take an exit, but otherwise hold on to this position.
Dharmesh, what are the views on the fundamentals? The stock is up about 5.5% today.
I mean, Q2 was supposed to be the best quarter for Amber Enterprises, where they did not perform as per expectation. The profitability loss is worrisome. And the point is the valuation is steep, very steep. It's only caters to the air conditioners, and going into Q3 where winter sets in for larger part of the country, the sales are likely to drop. So the only fear is this kind of a number can see a further degrowth going forward. Top line, I mean, growing your top line and operating profit, but getting a hit on the bottom line, because when you calculate PAT, interest component is also out there. It doesn't suffice well. So it was a concept kind of a stock where the valuation multiples were given earlier because of that in excess of 50. But right now, the type of opportunities that are available in other segments in the small and mid cap space, I don't think 50, 60 PE multiple with a growth of around 10-15% and uncertainty regarding the profitability is going to hold good for these companies. So it's an avoid for my end. If you want to have a position and which is in the same valuation multiple range, I think Dixon Technologies is a much better choice than Amber, which caters to all the segments plus the segments which are not there in Amber. For example, electronics and electricals is also there in Dixon, which Amber doesn't have. So multi-fold segment is what is the need of the hour. I mean, the person will switch to Dixon from Amber for a better prospect.
Okay. This is an interesting question coming in from Rajesh Maheshwari, writing in from Indore and asking about Som Distillery. He's got this stock at an average price of 341, which is slightly elevated, and he's got 125 shares. Now, this is a stock that is up 160% in the year-to-date period, and some of those losses have happened in the recent past after hitting those highs, right, of 380 or thereabouts. He's looking at the short to medium term outlook. So first on the technicals, Kunal, what levels would this stock find support at, and what kind of advice would you give to somebody who's bought at slightly elevated levels?
Alex, this was probably the trouble in the beginning of my career also, when I used to buy the counters which were in rally. But then always there has been a question on the risk reward ratio, unfavorable turning, and then it's turning, a burden for the person to hold the position. So same with Som Distilleries, I would advise our viewers, just don't initiate a buy when the counter is in a massive rally. Rather wait for the consolidation to come in. On Som Distilleries, what we can see is from July so far, this counter has consistently taken support near 300 mark. And on the higher side, it is finding the resistance at around 340. Watch out for these two levels. Hold on to the position for now. Think of buying near to 300 if the market settles here itself. That can be a good bargain buying opportunity. Stop loss in that case would be 290 and the targets would be 340. Once the counter manages to close about 340 decisively, I think the new rally might just continue. But the risk reward ratio is definitely going to be unfavorable. So keep trailing your stop losses if you're holding this position.
Okay. Any specific fundamental view, Dharmesh, on Som?
See, Alex, Som has seen a good price action because of the capacity additions which they have done, and the volume growth has been tremendous for this company over the last 2 years. And but it's still not a pan-India presence kind of a company. It's concentrated in Madhya Pradesh and Karnataka. I think going forward with the more foray to the other parts of and geographies of India, this company has a much brighter traction. So, and the management has just demonstrated, I mean, the capacity addition along with the volume expansion happening into their portfolio. So capability is not doubted, the product is not doubted, and I definitely see this company gaining traction across the different geographies of India. The only point being here is we are heading into election year, and there may be a lot of policy tinkering and taxation tinkering here and there with the consumption of alcohol. So that becomes a bit of a ceiling limit for next 6 to 7 years. So, but a good company to be added on declines, 18-17 of ROE with a growth CAGR of more than 20-25% on the PAT side is likely to be the scenario for this company for the next 2 to 3 years. So add on declines and hold on to it. If you're holding it for 2-3 years, I think the price targets can be much, much higher.
All right. Next up, we have a question from Naresh Thakur, and the stock that he's talking about is Prestige Estate. He has bought 100 shares at 728 rupees per share. The stock is up about 3% and is hovering around 770. He's asking if he should continue holding the stock or should he sell. Kunal, what do you think?
Again, this is a trending counter. The trend might just continue for beyond our imagination, honestly speaking. So yes, I would suggest a hold on to this counter, but a trailing stop loss has to be in place. And the trailing stop loss right now seems to be like 705 to 710 being the good level. So keep the stop loss of 710 and hold on to this position. I think this trend might just continue till the time there is a strength and the position is held on by the biggies in the market.
All right. Dharmesh, what's your view on the fundamentals? Is it a good time to continue holding the stock or should he sell?
See, real estate stocks, I mean, they are in a sweet spot and in the pinkest of the health. And whatever new projects any company is announcing, be it Prestige, Soba, DLF, or Oberoi Realty, it's getting sold into between 2 and 3 days. So now the norms have changed after RERA coming into play. People and investors, particularly who are investors as well for the second and third home, they are also having a comfort in parking out 5 or 10% of the upfront money, and then as the project completes, the balance of the payment is being made. So this has done a remarkable thing for all the real estate companies. Their working capital cycle has improved dramatically. At the same time, the interest cost burden because of the delayed projects and all is now ruled out because they have to stick to the timeline. So it's good for them. They're enjoying the tailwind of lower input prices across the board, and the prices have not moved up for them, input prices. So that's adding to their profitability again. I think with the per capita income rising to play, this is a very good, real estate is a very good basket buy, and Prestige is one of the outstanding performers out there. So the gentleman should be holding on to this stock, and if he's having a vision of say 2 to 3 years, again a decent return of 40-50% can be bought out there. And not to forget, just to add on, we are at the top of the interest rate cycle. So as the interest tapering starts happening in lowering of interest rate, real estate sectors will again have a more stronger growth than the 27-28% kind of a growth which we have witnessed so far this year.
Considerable upside is what Dharmesh sees. Dharmesh, the last question that we're taking is on Raymond. And incidentally, we were just talking about real estate. This is a company that is spinning off its real estate division kind of to have that focus on what it's known best for, which is the textile segment, right? So I believe that that's going to happen towards the end of this financial year, but the financials will be restated for the full year, is what I have heard from the management at the end of last quarter. What's your view specifically on the fundamentals of Raymond? And this is a question coming in from Mehek. Would you suggest a fresh entry at this point?
Yeah, definitely. I mean, anyways, you have to have a view of more than a year if you're buying Raymond for both the plays. I mean, textile as well as the real estate play. And the land parcel which Raymond is sitting on, in particularly in the Mumbai region, is huge, and the valuation cannot be, just ascertained on the back of the envelope kind of a thing. And I heard the management announcing about the ideas of the foray. So huge kind of a revenue they are expecting. 30-35% CAGR is easily there on the real estate side over a period of 2 to 3 years. So holding on to that stock for at least 2 years till the complete value unlocking happens, and then again this entire lower interest rate cycle and everything will play out over a period of 2 to 3 years. So I mean, the recommendation is hold on to it, and at least for a year you should be holding on to it. And after value unlocking, one can take a business specific call depending upon how the things are at that point of time.
Okay. It's up about 14% in the year, or 14.5% or so in the year to date so far. Kunal, based on the technicals, what levels are good to add to this counter?
So, Alex, if you look at the overall formation, the recent correction was definitely brutal, but now counter has come back to the previous support levels, which were at around 1700 mark. And these levels were seen somewhere near to July and August. So, I think this is a good level to keep an eye on. Once it gets into sideways consolidation mode, I think one can initiate a buy with the stop loss of 1675. But again, as I rightly said for the previous counters also, we'll not be in hurry to initiate buy. Let's wait for some consolidation to happen and then we revisit the counter.
All right. That's all the time we have for today. Thank you, Kunal and Dharmesh, for taking the time out and for answering so many questions for us and viewers. Thanks for tuning in. We'll be back tomorrow, same time, 11:30 a.m. Until then, stay tuned to BQ Prime.